Good morning and welcome to KW Property Management and Consulting's Budget Boot Camp. I'm Tim O'Keefe, Executive Director and Partner with KW. This morning's session will be a great kickoff to the 2021 budget season for many of you. For the board members and finance committee members that joined us today in HOAs and community associations throughout Florida, I think you'll get a lot of value from today's session. This morning, we are joined by two CPAs and community association budget experts that will simplify the budget process for all of you. Review best practices for completing your 2021 budget on time. Review mistakes made and pitfalls in the budget process so you don't go there. Explain the changes in revenue recognition standards for reserves. Provide guidance on potential increases for next year's insurance and utility costs. Identify how the COVID-19 virus can impact your budget next year, and answer any questions you may have. If you want to ask a question, you can type in on the Q&A icon at the bottom of your screen that you'll see. Please type your questions in there. We'll do our very best to answer all the questions that we can. So please let me introduce our two expert panelists who will take over from here. Today, we're very happy to have Rayne McGreevy join us. Rayne is the Audit Director for Stroemer Company. Stroemer Company is a prominent accounting firm based in Naples and Fort Myers area with offices throughout Florida. Rayne is a proud graduate of Florida Gulf Coast University. Go Eagles. She is a CPA and licensed community association manager. Rayne has been with Stroemer for almost 13 years and has completed more community association audits than she likely cares to admit. Also joining us today is Roxana Dorigo, an Executive Director of Accounting Services and Partner with KW Property Management Consulting. Roxana personally oversees production of hundreds of budgets created for KW Property Management clients. So let's get started with Roxana, who will provide us best practices for budgeting.
Great, thank you so much, Tim. So I thought of keeping it a little light and giving recommendations from KW and recommendations and best practices that we give our managers. And I wrote an article once and I used the word budget as an acronym. And I like to use it now to give you a little bit of insight as to what our best practices are. B, budget your time. U, understand the balance sheet line items and their effect on the budget. D, for divide and conquer each section of the income statement. G, gather all your contracts. E, evaluate collectability on delinquency and unit ledgers. And T, tally the results. So let's go on to budget your time. So there's a lot of—
Roxana, let me compliment you because there's a stereotype that accountants aren't necessarily always creative, but anybody who can take the term budget and make it an acronym for something has got to be pretty creative. So let's find out what you have behind this acronym today.
Thank you. I can try to keep it fun and lively. I mean, it's definitely a season that I love. At KW, it's the only process where the whole company comes together as a group. We have regional vice presidents that are involved in the budget process for each of their associations. We have district managers, we have the managers, then you have the accounting team. So all of us come together, and I'm very excited for this time because we're now putting together the game plan for 2021. And it's gonna be, one that we have to consider a lot of situations, especially because of COVID. You have to make a lot of assumptions where you're going to be in 2021 and in what quarter you're going to assess or recommend, assuming COVID is still around. So it is an interesting year. Let's just get started with budgeting your time because there's a lot of reviews inherent to budget. Budgeting your time is essential to making sure that we meet the deadlines. Most governing documents that I've read state that 30 days prior to the end of the year, you need to notify your owners of any increase or what the budget will be in the following year. But don't just assume that that's what's in your governing documents. I've also read a few governing documents that say 90 days, which means October 1st, you have to have your mail out. So in our recommendation is to have your budget ready and have the budget approval no later than November 1st. And the reason for that is twofold. One, if there's an increase in your budget, you want owners to know that increase and adjust their finances accordingly so that you don't have any collection issues come January of the following year. And the other reason why we have November 1st is because it's prior to holidays. You don't want the mail out to get mixed up with the mail that may be coming to the owner for holiday reasons, or the fact that they may be leaving town for the holidays. You want them to get that packet and make sure that they understand there would be an increase, or if the assessments will stay the same. So if we walk ourselves backwards from November 1st, we first have to do a mail out. Typically in a condominium, it's 14 days. In a HOA, sometimes we do follow the 14-day notice, but in other times it does depend on what's in your governing documents. In some cases I've seen where it's only a 2-day notification, it's a regular meeting. So there's not as strict rules as condominiums where there is a 14-day notice. So if we're saying November 1st is our recommendation to pass your budget, October 15th, you need to have a mail out, meaning the budget needs to be at its best, reviewed by your budget committee, your finance committee, or is it just two people that have been given the responsibility from the board? And those meetings take about a month of back and forth. So you're already back into September. So for us, we start August 1st, because first we give the manager, the district manager, the regional VP a chance to put in the proposed budget and discuss it amongst themselves. And then it goes back to accounting. In our process, it goes to accounting to review. And what we're reviewing for is making sure that our projections and our proposed budgets for next year are in line, and also the financial condition of the association has been addressed in the budget, which I'll speak about in just a few minutes. So our recommendation is mark your calendars. If you haven't started yet, it's time to start, because there's a lot of information that goes into the budget, as I mentioned. Marking your calendars with those budget timelines are super important. Determine when you're going to do the mail out, and then walk yourself backwards for the 14-day notice mail out, and then allowing time to review the budget. So,
Roxana, there's a comment that came in from Jose, which actually is kind of interesting. He's saying that, you know, because of the 2020 election cycle in October and November, do we need to think about, from a timing standpoint, more time for USPS to move mail?
Yes, that is a
really be an issue this year.
That is a great point. And we have seen delays in mail because of vendor payments, and COVID has played a factor into the postal system. So we've done a little bit of research, and we have found that there are decreased staff potentially at the Postal Service. And with the election coming in, that's a great point. That will even delay it even further. So more power to starting now if you haven't started, because there will be a potential delay in the Postal Service. So great comment.
Thank you, Jose. That was a very good point.
Moving on to the U in budget, understanding the balance sheet line items and their effect on the budget. So what I mean by that is determine if you have a positive or negative net cash position. Ask your accountant, okay? This is where the accountants play a role in the budget process. Also review your balance sheet for any due to or from reserves to operating, or operating to reserves. Because if you're not able to clear those by the end of this year because of a lack of funds, either way, either reserves or operating, then The statute states that you need to take care of it in the following year, at least talk about it. How are you going to remedy the situation? They don't say how you're going to remedy it, but you need to have a plan. And for us, when we see something like that, it is part of the budget for 2021. We may split it into 2 years. Again, the statute doesn't say how are you going to take care of deficits between the funds. They just say that you need to speak about it and start talking about not only deficits, but also surpluses during this time. They don't say how to calculate it. They don't give you guidance as to what is the plan that you should have in place. They just say you need to speak about surpluses or deficits and have a plan. So one partial plan would be to partially or fully have that line literally in the budget. If there's a surplus at your association, our recommendation is to withhold 2 months worth of monthly operating expenses in that surplus, because we are in a state that is hurricane prone. So for cleanup, for hurricane purposes, there would be unforeseen expenses. There could be unforeseen expenses at your association for any leaks, different situations that occur. So I could defend always keeping 2 months worth of monthly operating expenses in your surplus. Anything over and above that, again, going back to the statute, it says, what are you going to do with it? So you could defend the 2 months, but what are you going to do with the other surplus? Our recommendation is not to use it to lower maintenance fees, but rather to enhance the association. So you literally would have prior year surplus and a matching line of an expense called special projects. In there, the special projects would be to enhance and improve the association. Both would match, which means it nets to zero. It does not affect the budget. We would not recommend giving back the surplus to lower maintenance fees just because it's a yo-yo effect. That surplus will go away. It doesn't come back. And next year, the following year after 2021, if you've given a credit, there could be a potential higher increase than normal because you no longer have that surplus that was cushioning increases in contracts, increases in personnel, potential special projects. So again, giving back the surplus in the form of an actual project versus lowering maintenance is what we recommend. As far as deficits, literally it's an expense line. We usually call it recovery of working capital. If there's a deficit and it's too large to include in one particular budget because it would increase it too much, then we could split it into two years. So again, the balance sheet line items should not be ignored. It gives you the financial condition of your association, which needs to be talked about at the budget time as well. Moving on to D, divide and conquer each section of the income statement. Our recommendation is always to take a conservative view for other income and for expenses. And what I mean by that is, for example, for other income is only include other income if it's contractually obligated or legally obligation of a third party or even your owners. So if there's storage that you have and that can be leased to owners, of course include that. You have historical information. There is usually, and there should be, a lease agreement that is signed by the owner. So there's an obligation there that is binding to that owner. If you have any other income from external parties, make sure that it's a legal obligation, that you're not just including it, assuming they're gonna pay. We recommend not to put in late fees and finance charges. I do see sometimes a bit of an abuse in increasing increasing late fees and finance charges. And the reason why we don't like to include late fees and finance charges is for the following reason. is that you can assume you're going to receive 25,000, let's say, on late fees and finance charges. But once something is charged and an owner that has a good paying history, and the board has given the right to the manager to waive late fees and finance charges for that type of owner, there goes the money out the door. So what you thought you were going to receive, you're no longer going to receive. So late fees and finance charges, again, even historically, if you see a balance, it doesn't mean you've received those funds. You know, those are charges that could be even in collections and will take time to even collect, even further than 12 months. So be careful in adding late fees, finance charges. For expenses, make sure that you include all expenses, even wish list items. This is where we ask our managers, like I mentioned, walk your properties, listen to the owners throughout the year as to what has been their pain in their side as they keep on looking at a fountain that's not been completed or a fountain that's not working, as an example. You know, that is something that should be in the operating if it's not already in the reserves to fix that fountain. You know, landscaping, we hear that a lot from the HOAs. There's landscaping that is not cleaned up. Again, it's not like a reserve type item, it's more operational. Walk your properties, have your managers walk your properties to make sure that we have included those wish list items to enhance the association. And then just something for condominiums, there is a statute that says what type of expenses at a minimum need to be in the budget, which is administration, management fees, maintenance, taxes, insurance, security, fees payable to the division, other, and rent. And the reason why I put this here is that these items should be itemized. They should not be consolidated. As an example, fees payable to the division, sometimes people put it in licenses and permits, take it out of there. If your DPPR ever wants to review your budget, they would like it itemized and make sure that you have that $4 per residential unit in there as fees payable to the division. That's what I'm talking about, that $4 for condominiums to $4 for residential units. So again, just a little bit of guidance from the statute. We can move on to G, out of budget, gather all contracts. So separate the expenses that are supported by contractual agreements and those that are not. So having a section, literally, of contract on your budget is what we recommend. That is our normal structure. We have administration, we have utilities, and we have contracts. And it makes it so much simpler when the contracts are supported by the actual, document. So we have, as part of our process, we always have a contract binder easily accessible to us at every budget meeting. And the reason for that is I've gone to many budget review meetings, and the ones that go the smoothest are the ones where there is a contract binder. And the reason for it, because there could be an increase, and the anniversary date, let's just say, is June. That is when we're going to do the increase. We're not going to do it in January. We're going to do it in June. And inevitably, there are questions from the finance committee, budget committee, whoever is reviewing these budgets that we're preparing for them about a contract. Either valet or security are probably the ones that I've heard the most. If you do have both of them, having that contract binder and analyzing it and saying, here is the wording that we signed off on, that there's an increase in the budget, maybe 3% or 5%, whatever the agreement said years ago or last year where it was renewed. At least we have the contract binder. The budget discussions will go much smoother instead of second guessing yourself and not having that contract binder with you. Again, this is from a manager's perspective. Having that contract binder will assist you. And separating the contracts to be very visible on your budget will make it easier also to budget on a regular, annual basis. So then evaluating collectability of delinquent assessments. This is becoming particularly more important because of COVID-19. So as a management company of 250 plus associations, what we've seen in the last 5 months is that there has been an increase, even if it's slight. It's been maybe up to 3% increase in delinquent accounts for condominiums or HOAs, really condominiums where there is a high percentage of investor-owned units where they're renting. So it kind of makes sense. If the renter is not making money, maybe furloughed or laid off from their job, they're not paying their rent to the investor owner, and that investor owner in turn is not paying the association. So that's where we've seen an increase. If the condominium or HOA does not have a high rate of rent, we haven't really seen a change in delinquent accounts, which is good. But that doesn't mean that that's not going to change in 2021. So we are evaluating delinquency. To do that, we take the latest delinquent account, we take the attorney status report detailing the cases that they're working on, and a list of historical bad debt. So we're going to come up with a percentage, but we may increase it 1 or 2% to whatever the delinquency is in an association just because of COVID. We don't know what's going to happen in 2021. Again, the longer we're in COVID, there's a potential that owners or renters may lose their job. And there's still a possibility out there for that. So we may increase it 1 to 2%. And we're talking about the line item that's called bad debt expense. It's literally a line item that should be itemized and evaluated, especially in light of COVID. We can move on to the next slide, which I think is my last point, T for tally the results. So here is where we are looking at what is the increase. So we normally have to sign off on all different levels if there is a decrease in the budget, because that is atypical. It's not typical to see a decrease in a budget because there's inflation. There are contracts that have increases, and then you have personnel. Again, these are high ticket items. Usually the majority of your budget are made up of these. Your personnel, there's potentially increases to them for at least inflation rate. And so either you could keep your annual budget flat or there's an increase to the annual budget. So you need to analyze what the effect is on your owners, make sure that they're being prepared for that increase. And we recommend you having open meetings for these budget discussions. The way that we run these meetings is we have a signing sheet for the unit owners, and if they want to speak, they can basically check off a box that they want to speak during at the meeting. And the best run meetings that I've been to is we discuss the budget in an open forum, and then at the end of the discussion with finance committee, budget, or the board, then the owners are able to ask their questions. That way everything kind of flows correctly. And those open meetings are very important so that owners have an idea what's going to happen in 2021 into the next year. So that is all I have.
So thank you for that, Roxana. So question for you, Rayne, because you saw that, and I'm going to go back to one of the early slides where Roxana was talking about surpluses. What kind of direction or guidance do you typically give clients who go through audit as far as how much of, how much somebody should have and how much they should have in reserve as far as, or in surplus, as far as covering a few months worth of expenses? Is that in line with what Stroemer typically practices?
Yes, exactly like what Roxana had talked about. We see most communities carry a surplus for about 2 months which is normally able to sustain them for any type of major events like a hurricane, or even sometimes when they have unexplained items like COVID, nobody really planned for that. But if they did have some type of a surplus for about 2 months, normally that helps soften the blow of some of those unexpected and unplanned items and allows the association to kind of continue with business like normal and to be able to have enough and adequate reserves or adequate cash surplus to be able to pay for some of those different expenses that come up.
And then from a auditor's perspective, when you see a surplus, are they taxable?
Okay, great question. I get this one is probably one of my top 5 questions that we always get. And this is really where you have to start looking at your community and understand the type of tax return your association files. Now, most associations, they file a tax form 1120H, and the H stands for homeowners, but condo associations can use it as well. And for these types of tax returns, these are for your normal type of communities where maybe you have some type of a clubhouse, but you don't have large producing volumes of funds that come in. If you have interest and gate and all those types of normal types of income that come in, you're going to be filing that 1120H. When you're under that 1120H method of tax filing, that surplus does not become taxable. You don't have to worry about it. But you do kind of have to keep an eye on some of those other interest items that come in that might be taxable. Now, if your association cannot file the 1120H, you file what is referred to as the 1120, which is a regular corporate return. These types of tax returns are for a lot of those communities that have a lot going on. Maybe you're a golf course community and you're open to the public and you get different people who come in and pay dues to the association to play a couple rounds of golf. When you're an association that has an 1120 tax return, you have to look at your income and revenues, income and expenses that come in, break it by member and non-member. Then in those types of communities, if there is a surplus coming from your membership, then the association would have to pay taxes on it, or they could vote to roll it over to the next year as part of one of the revenue rulings. But they would have to have that documented in their meeting minutes. And you also need to be using that surplus up in the next year to avoid paying taxes. So if your community files an 1120, the best recommendation that I could say to you is talk with your accountant who prepares the tax return. Understand your community, understand if you have surpluses or losses for tax purposes so you can get the proper tax planning.
My best recommendation after all that explanation would be make sure you have a good accounting firm like Stroemer who can walk you through that so that you don't have to make those decisions on your own, because those are things that board members aren't necessarily all experts or CPAs. So take advantage of the professional services that you already are working with. And that'll help keep you out of trouble. And you can pull up your presentation, Rayne, as we do this, but we have a question from Harvey, and both Roxana and Rayne, you can weigh in on this because I'm going to give my opinion. But Harvey's saying that some HOA board members feel that quarterly fees should not increase, thus requiring the budget to be cut in order to meet the objectives. So on the other hand, should you let the fees fall where they may given increases in costs? What are we seeing in majority of communities for 2021? Let me start with this, and then I'll let you ladies handle it from here because I'll probably mess it up. But I would tell you, just as a general rule, it's not a 4-letter word to increase your budget a little bit every year. Costs go up, salaries go up. To think that you can keep your property's maintenance fees flat for 2 years in a row or 20 years in a row, I see that happen all the time. I walk into properties, they're so proud. We haven't increased our maintenance fees in 6 years. What have happened to your property values? They typically go down because you're not keeping up with the competition or the neighborhood. So you're seeing, the less you spend, the lower your values typically happen. So don't be afraid to increase your rates. It's not a lot. It's usually between 2-3% a year, maybe 2% is a pretty good average. And if you see yourself doing that, and your funding reserves 100%, you're going to be able to keep your property value where you want it. So when you sell someday, you're going to get all that money back. So you're not wasting money by increasing maintenance fees. That's my take, but I'll get the accountant's perspective as far as what are we seeing in budgets for next year.
So in budgets next year and last year, the average was about 3%. Again, just like you said, there are contracts, there's personnel increases, and the personnel increase is really dictated by the market. If you are able to, you should do a market analysis. Our recruiting team at KW does a market analysis every year to say, is that housekeeping rate that is being charged currently? If you were to replace that position, it's not about the person, but it's about the position. If you were to replace that position, what would it be now in the market? So there are increases to personnel. COVID is going to play a factor, into next year. For us, we're recommending that you assume COVID is going to be there till the end of the second quarter. So we're talking about 6 more months into 2021 with COVID being an issue. So definitely an increase is somewhere between 2 to 4% this year, this coming year. So that's my take on it, that decreasing a budget with inflation and contract increases, personnel increases is not a wise choice.
And Rayne, what do you say?
And I agree with that. Many communities, heck, nobody wants to, consider that their dollar isn't going to stretch as far as it used to. And that's just a factor of the society that we live in. We have inflation. There are increased costs. And if your community, for whatever reason is really pressuring you, to keep your costs as minimum as possible and maybe even to keep your assessments consistent with prior years, you're going to have to cut corners somewhere. And ultimately, that's going to reduce in lower values on your community. Your units won't be worth as much because you're going to have to not do as much landscaping or delay to some of these different projects that you wanted to do. So it's a really difficult position that many boards face because they have to try to do as best as they can and balance and weigh in all of those different considerations. But remember, if you're on a board, you have a fiduciary responsibility to the community to do what you think is best for the community, not just for maybe individual owners to keep assessments lower because they don't have the funds available. So make sure you're always keeping that interest in mind. What is the best thing I can do for this community as a whole? Not for individual people or not to make yourself popular. You need to make sure you're doing what's right for the community.
Great, thank you. And we do have a question from Tom that will get cleaned up right now. Tom's saying the term surplus, reserves, and available cash have been used interchangeably today. So the guidelines of 2 times monthly operating expenses coverage, does that relate to, is that cash on hand? Is that what
Cash on hand?
Okay.
Cash on hand.
All right, so Tom, hopefully that answers your question.
Yes, the term reserves is kind of a term that I hear many people use as just kind of a name to kind of mean money that they're storing on the side and almost like a savings, which from an accounting side, we would say that's like your surplus, just as Roxana said. It's different from reserves when we talk about statutory reserves. So I normally try to distinguish that with people when they're getting used to it, but the layman's term that most people use, they call reserves for that surplus that they're using. Completely different from those replacement fund for those major items.
And I want to ask you two ladies this question because I oftentimes see this in budgets when I review budgets. There's this category called contingency. And I'm always like, what is a contingency? Like you got $30,000 going into contingency. That's really a surplus that you're working off of, I believe. But what's your opinion on budgeting a contingency?
Okay, so I'm going to say these 2 things about it. When we talk about reserves, if I come across and doing an audit and in their replacement fund where you have your roof, painting, paving, and you have an item called contingency, I'm raising the flags that I'm saying, do not do this. You're not in compliance with what the statute says. Reserves have to have a specific identification of what they're for. So if you put something in there called contingency, there is no rhyme or reason, and there's no way that anybody can tell by looking at that what that's restricted for. Now, I do see some communities put in their operating budgets something that they call contingency. And really what they're saying is for some of these unknown and unexpected items. And normally with those types of things, I don't have too much heartburn as long as it's a reasonable number. If you're throwing $100,000 in there for, well, I don't know, maybe utilities are going to cost more, or all of these other unknowns, or maybe these special projects, I try to educate them and say, you know what, it's a better interest of you as a board member, as well as for the community, to be able to see and identify those different items and isolate them out and separate them out in your budget. Don't just be kind of lazy and just slop in a bunch of money into this contingency item. Make it have a specific purpose. This is your time as a board member to think about, what are some of those special projects that owners are always talking about that maybe we can do to please them? Let's put a special project line in there and consider some of those different costs in there.
Yeah. So for me, I don't love seeing contingency. It does happen, but it should, like Rayne, I completely agree, it should be reasonable amount. It should not be 100,000. I mean, if you have a budget of 2 million and you put 100,000 in contingency, you're not properly budgeting for other lines specifically, historically, looking at historical data. And so for me, contingencies should be reasonable, just like Rayne said. And also you should point out what is the contingency for, because there are certain line items that you don't know, like, some unforeseen expense. It could be for plumbing services because of leaks that have historically happened. And so you want to have a contingency line. You may have an estimate for plumbing services or repairs, but then you want that contingency to kind of say, well, it's for this, and this. I like contingencies that have a reason for them versus just putting on an amount without a purpose.
Okay, great. So, Rayne, why don't we get started with you? And you want to while you're pulling up you're sharing your screen to pull up your presentation. I do have another question that came in around surpluses. And the question is, how does the surplus operating income relate to retained earnings?
Okay. So a lot of times when we talk about surplus, which is excess of revenues over expenses, that really does accumulate in the balance of retained earnings. Sometimes it's called fund balance, other times it's called equity. It just depends on the way it's kind of named in your financial statements, or maybe names that you're familiar with. But those surpluses are accumulated in retained earnings or fund balance or equity. It's just different names, all for the same meaning.
Okay, hopefully that answered that question. And so why don't you, hopefully we didn't take all your presentation material away here, Rayne. Maybe we blew it and we're going to go through it all again, but I'll let you get started on a lot of the items that you have that are some of them much more technical.
All right, perfect. All right, so a lot of what I want to talk about today kind of relate to a little bit about my background and some things that so let me make sure my PowerPoint's going. There we go, perfect. Okay. So just so everybody understands my background, I have been working with community associations for about 15 years, specializing in only with associations, and I primarily focus on auditing associations. So normally I come in at associations after budgets are prepared and approved, and pretty much at the end. So with that being said, there's different things that I see from different angles than from somebody, like Roxana. And while both of them are very valuable, we hope that by the end of this, you're going to be able to kind of better execute this year's budget and making sure that you don't make maybe some of those mistakes or some of those other items that you need to make sure that you consider. So I'm going to spend a little bit of time today talking about budgets. I'm also going to talk a little bit about reserves to make sure that everyone understands the difference between the two different reserve methods and what's required to be in your budget relating to that. And I'm also going to go over some new revenue recognition standards that kind of changes the way some financial statements are actually presented.
Okay, and while we're getting there, I had another quick question that came in since it related to retained earnings. We just talked about that. I'd like to throw this at you, Rayne. Louise wants to know, how do retained earnings impact the budget process?
Retained earnings, and this was a little bit of what Roxana was talking about how you want to have, we were saying about 2 months worth of expenses saved as your surplus. That's kind of what we're talking about with that retained earnings number. it's the same concept. It's just the way it's presented on your balance sheet. So we were saying that the association should want to have a cushion of about 2 months worth of expenses, a surplus. You could also look at your retained earnings. You'd want a safe cushion of about 2 months, so that way you have adequate funds to pay for some of those unexpected items in case things occur. Okay. So here, as we start talking about the budget, I want to make sure that I highlight some of these frequently missed items that are included in annual budget. One of them is the beginning and the ending date of the budget. Now, many of you're going to be reviewing budgets. You maybe are going to be assisting with creating them, and many times these are created in Excel. And likely you're going to look at last year's and just populate the information and start changing numbers around. One of the biggest mistakes that I see many communities do is they fail to update the dates that they have in the top heading. This is just one of those embarrassing things that happen, and it becomes mass confusion when it's audit time, because I asked for a copy of the 2020 budget, but on the top it says 2019. So make sure you're checking to make sure that you indicate the proper date. It's also important that your budget isolates out the different types of assessments for each unit type. Some of your communities are going to have assessments vary based on 1 bedroom or 2 bedroom or 3, and that information also needs to be presented in your budget separately. You shouldn't just publish a budget that doesn't break out how much the assessments are by unit type. When you look at your expenses and you talk about your common expenses, the statute does require that your budget is presented on an annual basis. Even if you're monthly and quarterly, you can still present separate columns for that, but you do have to present the information in an annual format as well. Limited common elements. So limited common elements are some type of common area that the association has that only few people have the rights to. So let's think about carports, garages, maybe even cabanas. If you have limited common elements, there needs to be a separate portion of your budget that breaks out what those limited common element expenses are, and also identification of how much those limited common elements assessments are. This is because if only 3 of your owners, let's just say, have a garage, and you have 10 total units, you want to make sure that you're not allocating those 3 unit owner expenses amongst all 10 of those owners. So it's only the people who have the right to those items should be charged for them, which is why it should be segregated in your budget as a limited common item. Now, the big one that I'm probably going to spend most of my time on here today is about reserves. So if you're a condo association, you're required by statute to have reserves. If you're a homeowners association, your association is not required by statute to have reserves unless they have either been established by the developer or been established by the membership of the community. Now, once reserves have been established, if you're a homeowners association, or if you're a condominium association, your annual budget every single year must include your replacement fund items. And when you identify those different items, you're going to identify the component, identify the estimated total useful life of that item, the estimated remaining useful life of the item, replacement cost, the ending balance of that, and if you're a condo association, you have to include the annual funding on a fully funded basis. I'll go through some of those examples in just a minute. So I'm going to skip over a few slides here just to assist with saving some time. But when we talked about condo association, according to the statute, every condominium association must have a budget line item for roof, painting, paving, and any other item that has a deferred maintenance or capital expenditure greater than $10,000. So if you're a condominium association, and let's just say you have 2 buildings and each building has its own pool, and if you resurface the pool, and let's just say each pool costs $6,000, your community can choose to combine those 2 pools together for a total of $12,000 and reserve for them.
Yeah.
In addition,
I'm sorry, just as another example, a lobby. You know, the lobby has a lot of components that don't mean 10,000, but as a whole, to remodel your lobby, it will be more than 10,000. So you include lobby renovation or interior design, something like that as a component, just to add to what you were you're saying. It doesn't mean that every item has to be 10,000, but as a whole in one common area, the renovation of the common area can be over 10,000 as a project.
Correct. And this is the limit of what the statute says. At a minimum, you must have these line items. An association can choose to elect to fund for an amount less than $10,000. So let's give an example of maybe a wall that goes around the community and is expected to be about $5,000. An association can still choose to elect to reserve for some major item like a wall around the community, even though it doesn't meet the requirements of the statute. It is still something that the association can reserve for. This is at a minimum of what the association must do. So we talked already about homeowners associations, so I won't bog down your time with that. But I want to talk about two different methods of reserves, because this is where there's always a lot of confusion and a lot of questions. So the first one I want to walk through is a straight line. So in the straight line funding of reserves, this is also called maybe component funding. What you're going to have in your annual budget is you identify out all of your components, estimated useful life, remaining life, and cost. And then you're going to have a separate line in your budget for where you believe your beginning balance is, and then you're going to identify what your required funding is. Now, let me back up just one moment to talk about the straight line and the pooling and how they're different. And normally what I do is I have a wonderful visual, but I don't have it with me. But what it is it's a couple of different envelopes. And imagine this. If you have the straight line method of funding, you're going to have three separate line items. You're going to have one envelope labeled roof, one envelope labeled painting, and one envelope labeled painting. Roof, painting, paving. Maybe I got that mixed up there. Anyways, what funds you put inside that envelope is all it can be used for, because that's all that it's labeled for. And that's straight line funding. You can only use reserves for what they're identified for. Now, if an association was pooling method of reserves, imagine having a larger envelope. And in that larger envelope, you're labeling it roof, painting, paving, and you put all the funds the community gets inside there. You no longer can distinguish how much is for each individual item. All that you know is you have this giant envelope with this amount of money in it, and you can only use it for roof, painting, or paving. That's conceptually the difference between straight line and pooling. Remember, reserves can only be used for their identified purpose. So if you're under straight line, you have those individual envelopes with the individual labels. And when you're pooling, you have that giant envelope where you identify those different components, but it still can only be used for those identified purposes.
Rayne, there's a question that came in from Jack about straight line. So if I could ask it now.
Sure.
He's asking, can a percent be added for inflation to a straight line item?
Yes. An association can consider inflation on one of the different line items when you're preparing your budget. You're absolutely allowed to do that, both in condominiums and homeowners association statutes.
This may be a good time to talk about reserve studies. So unfortunately, there is no statute that requires reserve study. I wish there were. It would make my job a lot easier to explain why, reserve studies are very important, because reserve studies in our world, we recommend every 3 years to have a full reserve study where the engineer comes out and walks the property, asks you what has been, replaced, and they do a formal study. It's more costly, an average of maybe $3,500 to $5,500. But there are, if you built it into your reserve study contract, there could be updates. And the reason why I'm saying to put it into your contract is that usually they give you a little bit of a discount if you're also going to hire them to do updates for 3 years until you do the full study again. So every year we recommend that there be an update to your reserve study. The engineer is not necessarily coming out. What he's doing is actually looking to the market. If developers, as an example, are in the market, which in Florida, and if you're in Miami-Dade, you see the cranes all over the place, the developers are in the market, it's gonna drive costs up. And the engineer is taking that into account in an update. They also will take into account inflation. So replacement cost is what they will be looking at. And literally they're sitting in a desk for the updates. They're not really coming out to your property to do a formal walkthrough and a full reserve study. They're just corresponding with your manager, understanding what has been replaced during the year, updating that, updating the replacement cost, which is the important part, and for inflation and for the market. So just to add to what you were saying, Rayne.
Perfect. All right. Well, Tim, do you have a question? We can't hear you.
I'm sorry.
There you go.
It came in from Karen. It says, can't you put reserve dollars in a pooled category?
I'm not too sure exactly what she's referring to. You can have reserves when you fund them under the pooling method, like kind of that large envelope that I was referring to. I'm not too sure if that's exactly what she was talking about, but the associations can have reserves in Florida under two different methods. One of them straight line, where you identify out each component and you keep them in those separate funds, or you can fund them in a larger kind of envelope as I described it, which is the pooling method or cash flow method as some people call it. So I hope that addresses her question and comment.
Just, I want to add.
Go ahead. I'm sorry. Go ahead, Roxana.
Yeah, I just want to add that big envelope, and maybe this is maybe the question is that big envelope though, behind it is still the supporting reserve components. Just like you said, Rayne, it's not a free-for-all. Like you can't put something in a general pooled reserves. It literally in the statute, they updated it, I want to say in 2017, where they said it's forbidden to have general reserves, where it's not identified as what component is in there. Like you said earlier, there shouldn't be a contingency reserve because that doesn't exist. It has to be driven by the component. So behind that big envelope, you still have the reserve component. There is no general pooled reserves without any backup. Maybe that was the question, that can you just put it in a pooled reserve and use it for whatever you want? No, it's still supported by reserve components.
Right, so Karen, if that didn't answer your question, just please clarify your question and we'll do our best to answer it. Then another question came in, can the contingency reserve be transferred to the operating account, which is now in a deficit?
Okay, so talking about transferring funds and if you had a contingency type of reserve. So if your community, for whatever reason, had some type of contingency reserve or a reserve labeled something like general, where it really wasn't identified what it was for, what I would probably recommend the association do is consult with their attorney so that way you can make sure you go through this legally, because your community may have to go out to the membership and seek their approval for using reserve funds other than its intended purpose. Because that's really what the statute says. Reserve funds must only be used for their identified purpose. And when you have something that says general or contingency, you may want the attorney's assistance with clarifying. And if the attorney was to say, okay, the board can make a vote, or we need to go out to the membership, and then we can vote to transfer those funds over to the operating, then you can do it. Now, in a situation where, let's just say for whatever reason, the association is very short on operating cash. Maybe a hurricane happened or something like this, and the association wants to utilize the reserves. If you read the language the way it's written in the statute, that vote should be taken by the membership in advance. So those types of situations are really when you really want to work with your attorney, so you make sure you follow the law of the statute, as well as perhaps any other types of restrictions maybe that your governing documents have. So you can make sure that you can utilize those funds properly, so you don't get into a situation where now the legality of what was done is questioned.
So I think you already answered this question with that answer, but another question came in from Nancy Beth. So just let's be clear on it. Can the association borrow from the reserve for other needs?
Can the association borrow from the reserves for other needs? Technically, the way the statute is written, it should not be used. However, many associations do this. They a lot of times will use it for insurance financing purposes. And normally what I recommend associations do is I say, work with your attorney, consult with your attorney. I can't interpret the law on one way or the other. But if you read the language of the statute, it really does appear that the association should not be ever really borrowing from the reserve account to pay for operating expenses.
Roxana, you are shaking your head yes, so I know this is something
Yes,
you deal with.
I mean, I deal with this on a regular basis, where insurance wants to, you're right, Rayne, that insurance is one of those items where they're like, well, we have over $2 million in reserves. I'm not going to pay finance charges for insurance. I'm just going to take it from the 2 million. My recommendation is always, you have to pay within the year. You have to repay the reserves within the year. Every month we have a due to, due from, because we can't, we have to do the reconciliation of reserves to the cash. And if the cash is gone, it's a liability from operating due to reserves, because insurance falls under operating. So there will always be a due to reserves from operating until it's remedied. And our recommendation is, the board took the stance, the attorney said it was fine, and now we're faced with the statute that says that every time you take funds that is not for the intended use, you have to have a due to situation in, between the funds. And so we do document it, and my recommendation is always pay it off within the year that you incurred the expense.
So this is a question from Anna that I think is along the same lines. She says, if we decide not to do item A, I guess I'm spending money on reserves, can we use the funds for item B? I think it goes back to whether it's pooled or reserved or straight line reserves.
Well, I think you have to consider two things in that, and I'm just going off of what you just said, Tim. So if you include it in your annual budget, and let's just go by the example we have on the screen, that we're going to put in $15,000 into the roof replacement item, you have to put in that $15,000 if that was what was approved. If the association wanted to withhold that, and let's just say they wanted to use $10,000 of that roof, funding and, bring it over to the operating side to offset some other expenses, then you're probably going to need to consult with the attorney and go out to the membership and get their approval to utilize those funds for other than its intended purpose.
And then Jean wants to know, wouldn't the amount in the pooling have to equal the total amount needed for all the items to be funded?
All right, we'll go over that in a slide or two. So I don't know, I can get back to the slides and address some of that there.
Okay, let's keep rolling. Once you start talking about reserves, the world stops, and we can spend 2 hours on reserves. So
yes.
I don't want to, we're getting up on 11 o'clock, so we'll keep moving. We'll keep going because I think this is pretty engaging and we're still getting a lot of questions. So I think people are getting a lot of value. So let's keep rolling through your slides.
Great. And so what I have presented on the screen, this is just talking about on your annual budget. This is what your community is going to be having if you're under the straight line method, where you can see that we've identified our different reserve components. We've identified the useful life and remaining life replacement cost. Beginning balance, this is how much you believe at the beginning of that year that your community would have accumulated, as well as the required funding. Very simply, under the straight line method, to determine the required funding, normally this is just done as a simple calculation, but in this example, I think you'll be able to follow me. You take your replacement cost. This is your replacement cost of that item. If you wanted to factor in inflation, you certainly could. So you take your replacement cost, you subtract out your beginning balance, which was how much the community already has reserved for it, and you divide that by the remaining useful life. And in this calculation, 120 less 0 divided by 8 equals $15,000. So $15,000 is the required amount of funding that's required per the statute to be fully funded. If your community decided to, well, $77,000 to fund is just too much, we want to fund less than that, we only want to fund $40,000, then you're going to be going out to the membership because you're partially funding the reserves. Not a board decision, it's actually a community where you have to go out to the membership and seek their approval. So that's what you're going to have under the straight line method. Now I'm going to jump over to the pooling method. There's a couple of different things that you have to make sure that you include in your budget if you're going to, or if you have under the pooling method of reserves. When you do this presentation, and I'll show it to you on the next slide, You have to make sure that your ending balance can never go below 0. Your funding formula cannot include balloon payments, and your calculations have to go out as long as the remaining useful life. So here is that exact same example of the different components that we had under the pooling method of reserves. We still identify the components, useful life, remaining life, and costs. Now remember, one of the things I said, we have to go out as far as the longest remaining useful life. Remaining useful life of the roof is 8 years. So in this table, we have to go out 8 years. Then what you start to do is under each of the applicable years, you drop in where those expenses are expected to incur. So then you have your projected total cash outflows for all of those years. We have our beginning cash balance, and in this one, we're starting the beginning of the year with 0. We have 0 expenses for year 1, and we've estimated annual reserve contributions to be $47,000. So in this calculation, you can see the ending cash agrees to the next year's beginning cash, and you could see that this annual reserve requirement is $47,000 for all of those years. So you see how this is remaining flat. We're not having it where it's going 30, 30, 60, 90, whatever it needs to be to make sure that this ending balance does not fall below 0 or become a negative number. So under this presentation, under the pooling method, the association could fund $47,000 each year to be in compliant with what the statute says. Couple other things I want to make sure that people are aware about when we talk about reserves and straight line pooling. So when your association wants to switch from the straight line method to the pooling method, for whatever the reason may be, you need to make you aware that there are 2 different types of votes that have to be done. The first one is, how are you funding those different items? So think about, how are you putting money into the envelopes? Are you now going to be putting money into the larger envelope, where you're going to be putting it in via the pooling method? The second vote that you'll have to take is for the amounts that have been previously accumulated. So now if you can imagine, if your community has all of those funds inside each of those separate envelopes, and now you want to put it into the larger envelope, you have to get the membership's approval to use reserves for other than its intended purpose, meaning to take money out of those separate envelopes and to put it into that larger one. So it's a 2-part vote. Many communities, unfortunately, they misunderstand it, and the boards believe that they have the right and the power to switch completely from the straight line to the pooling. And it's not until the audit actually comes into place that they realize that there were some issues there and they have to make a couple of corrections.
Okay, so Rayne, one of the questions, for example, a question came in from Jean about, how did you determine the $47,000 annual contribution for reserves? Because the original fully fund, I think it was $77,000, and you picked 47. So she's saying, how'd you come up with that number?
Okay, really what it comes into play, and most of the time when associations use the pooling method, they actually have a formal reserve study done. And what the formal reserve study done is, they'll prepare this calculation and they'll prepare this schedule for you. And they'll likely even go out further and more beyond some of this. So they factor in a little bit more considerations than that we have done. But if for whatever reason your community wanted to do these factors themselves, really what you could do is, if this was set up in an Excel type of situation, you could figure out what number do you have to have, and you intend to try to keep it consistent for all years. What number do you have to include here as the reserve contribution so the ending balance never becomes 0? It's going to depend on what your beginning cash is, so you have to factor that in. But when working with some of these different types of schedules, you should be able to kind of go in and say, well, instead of 47,000, let me try 30. If I put in $30,000 every year, would I have enough cash to be able to keep everything a positive cash flow? So most of these things are done by your reserve study company who prepares this schedule, because this schedule can, for some communities, get very, very complex. And it's really probably one of the best advice to use actually a professional and not do some of this information on your own. But we've just simplified it for this presentation purpose.
Okay, and then Anna clarified her question. That was a question, if we don't want to do it in A, can we do it in B? So this is a real question. If we decide not to renovate the office, can we allocate those funds to another item on the schedule?
Okay.
Only with membership vote.
Correct.
Okay.
Only with a membership vote. If it's straight line.
Membership vote.
Yeah, if it's straight line. In pooling, you know, there's a lot of assumptions also made in the pooling, you know, funding. And sometimes it's happened to me where, you know, the board, there's 5 projects that is targeted for next year. It's impossible to get through all those 5 projects. They have to prioritize, you know, let's say life safety first and then all the other projects that may be, you know, happening just because they happen to have the same remaining useful life. These are assumptions made by the reserve study specialists that in their professional opinion, everything has to be done in 1 year. But the reality is it just can't be done just because of time. You know, we're going to run out of time and these projects are not going to get in year number 1. It may get done in year number 2. So that's where, you know, updates to the reserve study can come in. Sometimes we do move out the expenditure ourselves because we know it's impossible to do 5 projects, you know, major projects in 1 year. It may have to be moved. So that's also a consideration.
Okay, and then Sandra is asking, how do most associations handle common area elements such as lobbies? Is it advisable to include common area maintenance in reserves or just handle them by special assessment?
I think the best route is to handle them in the reserves. Make sure that your reserve components are complete. Operating, you know, that is like a special project. If you want to do a lobby renovation and it's not in your reserves, you may be inflating your budget by a higher amount than the average that we're talking about, 3% or so. It may go up for 1 year and then maybe go down. So it'd be better to have it in the reserves. I mean, if you don't have it already, maybe contact your reserve study specialist and engineer, make sure that it is in the update for your reserve study.
Okay, and Rayne, another question. Could an association membership vote to put the interest earned on reserves into the operating expenses?
Okay, great question. This is actually something that it actually says pretty clearly in the statute. Any interest earned in the replacement fund must remain in the replacement fund. So you really have to keep it in the replacement fund. Now, I assume an association can get a little bit creative with some of this and they can say, well, we want to allocate $10,000 from our reserves over to our operating, and $10,000 coincidentally happens to agree with how much the interest is. They can be done likely as a vote, but not as a policy where any interest that gets earned from the replacement fund automatically comes over to the operating.
Okay, thank you. So why don't we run through, you know, we're about 8 minutes after the hour, but we still have a lot of engaged people here. So why don't we run through the rest of your presentation? And I know there's still a big area you haven't covered yet relative to revenue recognition.
Yes, and I'll try to go through that as best as I can in as short of a period of time as I can. So what this is talking about a new revenue recognition, and the common slang, I guess, that us accountants use is 606. So basically it's a new standard that has come out. This standard has been around for a few years, but it really hasn't been impacted or required by associations until recently. And there was a lot of talk as they started to develop this standard and start actually implementing it for other types of corporations that perhaps our community associations were going to be different and we were going to get different guidance. Well, I'm here today to talk a little bit about some of that and how we didn't quite get the guidance that actually we had hoped for, and it does change some different presentation things. So when we look at this revenue recognition standard, now when you recognize revenue, you actually have to go through a 5-step process before you could recognize the revenue. So, and I'll just go through briefly what these steps are. You have to identify your contract with the customer. So when we look at an association, we think contract with customer, and our customer is our unit owner because they're a customer of the association. They become part and they become contractually obligated with the association when they purchase the unit and they become accordance with acceptance with their declaration. The next step is identify the performance obligation. And this is really where it becomes a big changer when we talk about operating in reserves. So part of your obligation and contract between the unit owners and the association is the unit owners are going to be paying assessments to the association. And in return, the association is going to provide landscaping and utilities and all different types of services for that community. So that's really the performance obligation that the association has. The third step is identifying the transaction price. And again, that's really going to be following your budget. This is how much we're going to be exchanging in relating to this transaction. The fourth one is you're allocating the transaction to the performance obligation. And the fifth step is recognizing the revenue when or as each performance obligation is satisfied. So I'm going to skip over this next slide here. And I'm just here to make sure that you're aware that this new standard, when it actually came out for associations, that they had to follow it, they had to follow it for years beginning January 1st, 2019, which means your December 31st, 2019 financial statements should have been in accordance with the new revenue recognition standard 606. Now, I do kind of want to let you know, about a month or two ago, there was some publications from the AICPA, and they were allowing some communities to extend this, or allow any entities, not necessarily communities, to extend this deadline to 2020. But many communities have already started opting in, and they've updated their financial statement to be in compliance. So if you're kind of in that limbo state where all of a sudden now you're panicking, saying we should have done something last year, but we didn't, what do we do and how do we handle things? You will get a brief kind of extension period, but this is definitely something that you want to make sure that you begin educating yourself about and making sure that your financial statements are now starting to line up with this new standard. So let's break it down for our communities, because our community associations have to follow this, because this is a generally accepted accounting principle, and the Florida statutes require annual financial statements, meaning your audits, reviews, compilations. They must follow the generally accepted accounting principles. So your community must actually follow these new revenue recognition standards. So when we talk about our operating side of our financials, there really isn't a whole lot of things that are going to be changing, because as you start going through the different 5 steps, every single minute of every day, your association is providing some benefit to the owners, whether that's just keeping on your electricity, keeping up with your insurance, or maybe for some of those different items like mulching. You're continuously satisfying some type of performance obligation. So your association has the right to continuously recognize revenue. So when you look at your income statement on your financial statements for operating assessments, there really isn't going to be any change. The only exception to that has to do with 2 primary items. One of those has to deal with bad debt. Now, based on the new standard, it's interpreted that bad debt, meaning those unit owners who are not paying or have not been paying on their assessments, that you should never have recognized that as revenue. Now, I understand from a management perspective, if let's just say Mrs. Smith in Unit 1 hasn't paid her assessments for the last 6 months, and we don't expect to be collecting her assessments on October 1st, so we shouldn't be recognizing her revenue. It's going to make kind of a hard time from your financial statement perspective and your monthly financials not to charge that as revenue. So what we see many communities do is when they have a line item bad debt expense, instead of not recognizing it as revenue, we tell our communities, well, can you move that bad debt expense line item and make it just below your assessments? So that way your assessments equal your budget, and then the amount that you're not expected to collect from your members still be included in bad debt, but now it's actually not included with total revenues. And that's a way that some associations may be able to change some different things from an accounting side and get to the same perspective of where the new standard requirements are. The other types of things that kind of come into play is talking about an agency transaction. And really what this has to do, and I'm sure many of you are familiar with, when you have a master and a sub relationship. So let's just say you're a sub association and you charge your unit owners for your association dues, but you're also charging them for the master dues, and you're assisting the master with collecting of this. In that type of situation, the sub association is an agent. They're just collecting the dues and transmitting those funds over to the master. And what the new standard says is you should not be recognizing that as revenue because you didn't really do anything to earn those funds. You're just acting as the agent and you're collecting those dues and passing it along. So what many community associations do is they just move that line item on their income statement where you have your master assessments and then you have an expense line for your master assessment expenses, and they kind of net those two together where they're able to offset each other, and now they're no longer included in total revenues. Again, just changing a little bit of the way things are presented, still the same information, but now it's no longer included in your total revenues, and now you're also in compliance with what the new standard says. So now here's really where the big change is when we start talking about reserve assessments and the way it gets recognized. Now this has nothing to do really with your budget on how you estimate and how much you determine to fund. It really just has to do with your income statement when you look at it on a monthly basis of understanding what gets recognized as revenue and when it does not. So the key word that I want to make sure that you take away from this is performance obligation. And when you think about reserves, I'll give you this example. Let's just say our community association levied $10,000 last year for the roof, but we did not replace the roof. We did not satisfy our performance obligation. And if you remember, we must satisfy the performance obligation before we can recognize it as revenue. So when our association collected that $10,000, we can't recognize it as revenue because we didn't satisfy the obligation. What we now have is we have a future obligation, a liability to replace that roof at a future point in time. So now the amount that the association has accumulated for reserves that have not been spent is going to be presented as a liability section on your balance sheet because the association has a future liability. Now, depending on how different things are set up in your accounts and on your financial statements, this may already be sitting there as a liability, or this may be sitting as an equity. But you'll just sit and take a look at your financial statements and understand that things are now going to be moving to a liability. Maybe just work with your accountant and just to make sure that everything is lining up. But really the big change really has to deal with the reserves. Now I want to kind of quickly give you a visual example of what some of this looks like. So if you look on the screen on the left side, you're going to see all the information of the way it was presented previously. And I'm just going to highlight really the reserve item because that's really where the biggest change comes into play. So as we look at our different line items on the reserves, we see down here, we identified here is our reserve balance. The association has accumulated $114,000 for reserves, and it's in this section down here that's labeled fund balance, which is also retained earnings and equity like we talked about earlier. So the association has $114,000. If you look over here on the right side, this is based on the new standard of the way the financials. We now have this liability section of the financials, and we have this line item. We're calling it deferred maintenance and capital expenditures. There's that $114,000. So now it's just changing it from an equity over to a liability section. That's really all that primarily is going to be changing on your balance sheet. Now, as we start to look at the income statement side, this is where you're going to start seeing a little bit more changes. And I'm going to focus on the replacement fund because that's really where the big changes are. So under the left side, this was under the old method. So the association charged $17,000 for reserve assessments and had $3,000 of expenses. But remember, they haven't satisfied that performance obligation. Under the new method, you have that $3,000 of expense, but now they incurred that $3,000, they can recognize that corresponding $3,000. So that's really where you're going to start to see your changes when you look on the income statement of the replacement fund. That's where some of the numbers are really going to change. On the balance sheet, it's just the presentation and where those items are presented. All right, Tim, I don't know if you have any questions of people related to that, but that's about all that I have. I know I went over a lot of stuff, but hopefully everybody was understanding a little bit of what we were kind of talking about there.
So we do have a few more questions, but I think they're still relating to reserves. So
Sure.
Let me clean those up if I could. Thomas wants to know, how do you treat a cost overrun on a reserved item?
Okay, cost overrun on a reserve item, it depends on what method you're using. if you're under the straight line method and you've only saved $10,000 for an item and it costs 11, well, now you're short $1,000. The association can see if there's enough operating funds. The association could special assess, or the association could also go out to the membership and say, can we take that $1,000 out of XYZ component? So that's straight line. If your association was under the pooling method, really all you have to do is make sure that you have enough funds in your total pool to be able to meet that expenditure. So if you have $100,000 sitting in your large pool envelope and you only thought it was going to be $10,000 for an item, but it's 11, as long as there's $11,000 sitting in there, you'll have enough to be able to do that. But make sure you include that new estimate when you're preparing your next year budget so you can account for it.
Yeah, that's what I was going to add, that now you know the replacement cost that the engineer or reserve study gave you is not exactly what it should be. So now you have to incorporate it into the next replacement period for that item.
And then Roxanne, another question from Jean. Could an association membership vote to put the interest earned on reserves into the operating expenses?
I mean, it is a part of the reserve fund. So absolutely, there could be a membership vote that says move the amount of interest over to operating. It's, again, membership vote would
and regarding reserve studies, Tom's asking, when and how should the association challenge the reserve analyst's estimate on a large ticket item where the analyst has listed a disclaimer? His example is with a roof replacement. The analyst says the replacement cost has not been validated with an independent engineering review. Without accurate cost information, the funding requirement could be under or overstated. So how's that get addressed?
Well, for us, you know, this is almost like saying you're questioning the reserve study. I would call a vendor. I would call a roof vendor to come out and give us a free estimate. We do it all the time when there is no reserve study to be, you know, to work from, or the reserve study is really outdated. We actually have our managers call the vendors, come out, give me an estimate, and it's usually free. So that's our recommendation. If you have a conflict with the reserve study, you could always call a roof vendor to come out and give you an estimate.
And then I have another question. I'll throw this at you, Rayne. It's a self-managed property, and they're saying that, basically talking about surpluses, their practice has been to transfer surplus to reserve fund at the end of the year. And there's a new treasurer that's moved in and saying, isn't this actually taxable based on Revenue Ruling 7604, needing advance notice and voting by board members? And then operationally, how does a budget team budget for an anticipated excess 2 to 3 months in advance of the new fiscal year, and then get owners to approve an estimated excess and transfer that, then gets into the new budget? So there's some confusion there, and this is how they've done it for 27 years. They've never really gone to CPA and gotten any help because they're a small HOA. So this workshop today, or boot camp, has probably been pretty helpful for them, but how would you address that?
Okay, so again, talking about that surplus, it really depends on what type of tax return. If you're filing the 1128 and you have a surplus, you don't have to worry about taxing at that point. So if an association files the 1128 and then says, we're going to transfer this $20,000 surplus over to reserves, go ahead. You don't have to worry about tax implications. But if your association was an 1120 type of tax return, those are more corporate type of associations. Then in those types of situations, if you have a surplus and some board members or some people think they can be creative and say, well, let's transfer it to reserves, they won't have to pay interest. That's completely false. So if you're under the 1120 type of tax return, corporate type of tax return, and you have a surplus, if you want to transfer it to reserves, you can, but you are likely going to have to pay taxes on it first.
Okay, so you guys have done an awesome job of covering a lot of great information. And for the audience listening today, thank you so much, because you asked great questions, made it really engaging. We kept almost the entire audience, all hour and 24 minutes so far. So thank you for that. I'm going to have just one parting shot, if I could, from each of you. So Rayne, do you have a parting shot as far as, let's make sure we don't do this wrong, or best practice you want to make sure gets right for 2021 budget?
All right. So one of the big things, and I use this with just about every aspect of my life, prior planning prevents poor performance. Make sure that you're planning for 2021. 2021 is not going to be like this year. It is going to be different, and you're going to be facing new challenges. So make sure that you take your time, put forth your best effort. You know, if you need additional guidance and stuff, reach out to the experts in the applicable field so that way you can put together a good budget for 2021. Because my anticipation is, with everything that's going on with COVID, it's going to be around a little bit longer, and things are going to be a little bit difficult for probably the next 6 months, maybe even a little bit longer. But if you can plan it now, you'll have a much more successful 2021.
And let's not confuse prior planning prevents poor performance. That's 5 Ps as opposed to PPP, which everyone's been asking about. Do we qualify for a PPP payment? So we won't go there. That's the government relief. But there's a lot of P's in all of that. So Roxana, your final
I
comment.
actually want to support what Rayne said. It's about budgeting your time, because there's a lot that's happening, you know, on a regular basis on a budget process. But now we have COVID on top of that. And so what we've done is we've itemized all of the COVID related expenses, including any personnel transfers to cleaning, to extra supplies, any other expenses are itemized on non-budgeted line items so that we understand these are COVID related expenses. And all of that extra information has to be incorporated into 2021. As I mentioned earlier, we're assuming COVID is going to be in, because we have to make assumptions. We have to make some type of assumptions. We do have food and beverage outlets and some of our properties, so we have to make some assumptions, which most of our boards have agreed with, which is COVID is going to be with us, unfortunately, through the end of the second quarter. And the other thing to leave, you know, the seminar with is that be conservative when you're looking at your budget. You know, again, look at your other income, be very honest with yourself. Are you going to receive that money? Is it guaranteed? On the expense side, COVID being a problem, you know, you have to address it in 2021, unfortunately. Personnel increases and inflation. So be careful and be conservative.
Okay, thank you for those final comments. And ladies and gentlemen, thank you for joining us today. If you love this webinar bootcamp and you want to watch it again, we will post it on our website at kwpmc.com. Happy to share it with you too. Rayne, if you'd like to post this on your website at Stroemer, we will get you the link and you can watch it there as well. For all of us, on behalf of KW Property Management and Stroemer Company, thank you so much. Have a great fall. Get started on your budget. Get started early. Wash your hands, wear your masks, continue to socially distance, and hopefully next year when we do this, we'll be out of the weeds and we'll be able to be more engaged face to face. Thank you all. Have a great rest of your week.
Thank you. Bye. Thank you. Bye, Rayne.